Stocks dropped 1,000 points on Friday. Oil has a nice little jump. You know, that XLE, that XLE, that's the energy sector, and watching my BPT still collecting that dividend. But why did this happen? The Jackson Hole Economical Symposium went on out in Jackson Hole, Wyoming. I'm not gonna lie to you guys and girls. I tried to get out there this year, but I found out at about the last minute, and I wasn't able to make the dots connect. But I will be back. I will try again next year, and it has been gone for the last 2 years. So y'all gonna sit back. We're gonna hear Jerome Powell. Why did the stocks drop 1,000 points after he spoke at the Jackson Hole Summit? But ladies and gentlemen, if y'all haven't done so already, please go ahead and make sure hit the subscribe button, hit the bell icon, hit that like, comment, and share button. Once again, ladies and gentlemen, boys and girls, and children of all ages, you're now tuned into the Investor Show. As always, this is the gracious host of Prince of Investing, Prince Dykes, coming to you guys and girls live all the way from this beautiful city and state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. And as always, I don't have a lot of time, and I definitely know you guys and girls don't have a lot of time, so we're going to jump straight into it. Here we go, ladies and gentlemen. I'm going to play the opening remarks by Mr. Jerome Powell, our Fed chair, who was at the Jackson Hole Economical Symposium out in Jackson Hole, Wyoming. This has been going on for 40 years. I heard about it for the first time 2 years ago, but the pandemic was going on. They had stopped it. All the head honchos in the financial world and the world comes here. So when I found out about it, I tried to make a way to get there, but it was too late. I didn't get anything back, but it's going to be on my to-do list next year. But without further ado, let's go ahead and play it. Make sure, tell me if y'all can hear this. I want to make sure you guys and girls can hear this, okay? Go ahead, here we go.
Yours, please come to the podium.
Thank you, Peter, and good morning, everyone. Esther, thank you very much for the opportunity to speak here today. At past Jackson Hole conferences, I have discussed broad topics, such as the ever-changing structure of the economy and the challenges of conducting monetary policy under high uncertainty. Today, my remarks will be shorter, my focus narrower, and my message more direct. The Federal Open Market Committee's overarching focus right now is to
Sorry about that mishap I had there earlier, but hey, we're going to make it happen. Let's get back to it. Jerome Powell, he's live. Let's go.
Thank you, Peter, and good morning, everyone. Esther, thank you very much for the opportunity to speak here today. At past Jackson Hole conferences, I have discussed broad topics, such as the ever-changing structure of the economy and the challenges of conducting monetary policy under high uncertainty. Today, my remarks will be shorter, my focus narrower, and my message more direct. The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The burdens of high inflation fall heaviest on those who are least able to bear them. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions.
All right, I want to pause
While
that.
Higher interest rates, slower growth, and softer labor market conditions will bring down inflation.
I'm sorry about that. I want to pick. He just said, hey, with this high inflation, it will soften the labor market, right? Right here, we spoke about it. Everybody said, what recession? Unemployment is at 3.5%. Man, it's telling you right here, get ready for some dark times because this inflation will probably soften the market. So pretty much in the beginning, he's saying in a bunch of economical terms, get ready for an ugly time. Let's go, Jerome.
Inflation, they will also bring some pain to households and businesses.
Pain. These
are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. The U.S. economy is clearly slowing from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. While the latest economic data have been mixed, in my view, our economy continues to show strong underlying momentum. The labor market is particularly strong, but it is clearly out of balance, with demand for workers substantially exceeding the supply of available workers. Inflation is running well above 2%, and high inflation has continued to spread through the economy. While the lower inflation readings for July are certainly welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down. So we are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25% to 2.5%, which is in the summary of economic projections range of estimates of where the federal funds rate is projected to settle in the longer run. In current circumstances, with inflation running far above 2%.
Ladies and gentlemen, he's telling you guys and girls, listen, there's going to be some hard times. We want inflation to be at 2%. It's now running at 8-9%. And he's saying that, hey, we just don't need inflation to stop for 1 month. We needed to show a downward projection. So last time they rose the interest rates by 75 base points. And they're saying, hey, yeah, in July, we saw inflation kind of topple out at 8.5, but we want to bring it down to our goal of 2%. And he's pretty much saying, hey, households, we can't do this. We can't raise interest rates without households feeling the pain. What does that tell you going into the future? And he's going to get into some historical stuff here too about Paul Volcker. Let's go.
2% and the labor market extremely tight. Estimates of longer run neutral are not a place to pause or stop. July's increase in the target range was the second 75 basis point increase in as many meetings. And I said then that another unusually large increase could be appropriate at our next meeting. We are now about halfway through the intermeeting period. Our decision at the September meeting will depend on the totality of the incoming data and the evolving outlook. At some point, as the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy.
Okay, here the history.
Committee participants' most recent individual projections from the June SEP showed the median federal funds rate running slightly below 4% through the end of 2023. Participants will update their projections at the September meeting. Our monetary policy deliberations and decisions build on what we've learned about inflation dynamics, both from the high and volatile inflation of the 1970s and 1980s, and from the low and stable inflation of the last quarter century. And in particular, we're drawing on three important lessons that I'll highlight.
Here they
The
come.
first lesson is that central banks can and should take responsibility for delivering low and stable inflation. It may seem strange now that central bankers and others once needed convincing on these two fronts. But as former Chairman Ben Bernanke has shown, both propositions were widely questioned during the Great Inflation period. Today, we regard these questions as settled. Our responsibility to deliver price stability is unconditional. It is true that the current high inflation is a global phenomenon, and that many economies around the world face inflation as high or higher than seen here in the United States. It's also true, in my view, that the current high inflation in the United States is the product of strong demand and constrained supply, and that the Fed's tools work principally on aggregate demand. None of this diminishes the Federal Reserve's responsibility to carry out our assigned.
Now, Jerome Powell, I got to stop you there. He's saying that, hey, our inflation is due to the high demand and restrained supply, which is true. Prices are reflected by that way. But don't forget, we pump trillions of dollars into the market. And when you pump trillions of dollars into the market, it's going to increase demand. Remember in Germany, during World War II, I think it was Germany, when they dumped a bunch of their currency into the country, when you give somebody a bunch of money, it's automatically going to increase the supply, not the supply, it's going to increase the demand for goods and services. So, when he said, hey, he's right, demand is high, supply is low, but nobody's talking about why that demand is high. Remember those trillions and trillions of dollars of stimulus? It's the gym. Let's go, Jerome Powell.
Task of achieving price stability. There is clearly a job to do in moderating demand to better align with supply. We are committed to doing that job. The second lesson is that the public's expectations about future inflation can play an important role in setting the path of inflation over time. Today, by many measures, longer-term inflation expectations appear to remain well anchored. That is broadly true of surveys of households, businesses, and forecasters, and of market-based measures as well. But that is not grounds for complacency, with inflation having run well above our goal for some time. If the public expects that inflation will remain low and stable over time, then absent major shocks, it likely will. Unfortunately, the same is true of expectations of high and volatile inflation. During the
So he spoke about this. He's saying that the public perception of inflation could affect inflation as well. Like if people think inflation is going to drop, then it will. If they think it's going to keep rising, they will do it. And he's about to give a historical context of back in 1979 when this did happen. Let's go.
1970s, as inflation climbed, the anticipation of high inflation became entrenched in the economic decision-making of businesses and households. The more inflation rose, the more people came to expect it to remain high, and they built that belief into wage and price decisions. As former Chairman Paul Volcker put it at the height of the Great Inflation in 1979, inflation feeds in part on itself, so part of the job of returning to a more stable and more productive economy must be to break the grip of inflationary expectations. One useful insight into how actual inflation may affect expectations about its future path is based in the concept of rational inattention. When inflation is persistently high, households and businesses must pay close attention and incorporate inflation into their economic decisions. When inflation is low and stable, they are freer to focus their attention elsewhere.
what he's saying right here is why the retail industry is struggling so bad. He just said when inflation is high, people have to pay attention about what they're spending. When inflation is low, people can focus their areas, focus elsewhere when they're spending money. So he said if people have the mentality that inflation is high and going to continue to rise, it would affect wages. Everybody would just kind of go into the whole. I can agree with that to a certain degree. Companies start to hire a certain way. People start to spend a certain way if they believe something, because the brain is very powerful. So they're going back to 79. They said that, hey, with inflation being so high, people will start to be careful of where they start to spend money. This is why you're seeing Amazon and retail industries and Walmart be the hardest hit sector so far with inflation. Let's go.
Former Chairman Alan Greenspan put it this way: for all practical purposes, price stability means that expected changes in the average price level are small enough and gradual enough that they do not materially enter business and household financial decisions. Of course, inflation has just about everyone's attention right now, which highlights a particular risk today. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. And that brings me to the third lesson, which is that we must keep at it until the job is done. History shows that the employment costs of bringing down inflation are likely to increase with delay as high inflation becomes more entrenched in wage and price setting. The successful Volcker disinflation of the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years. A lengthy period of very restrictive monetary policy was ultimately needed to stem high inflation and to start the process of getting inflation down to the low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve now. So, these lessons are guiding us as we use our tools to bring inflation down. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we're confident the job is done. Thank you.
He just said, hey, we're going to do whatever we can do to stop and slow down demand. How can you do that? How can you slow down demand? One, raising interest rates, tightening up the money, making money harder to get, making people, if people have less money, they're going to slow down demand, right? A quick way to slow down my demand? Hell, take away my income. That'll definitely slow down demand. So right here, y'all, this is the opening remarks to the Jackson Hole Economical Symposium that happened earlier this week. I think it was 3 days. I tried to get out there like I was saying earlier, but things didn't line up. I didn't get a chance to make it. But I'm going to try it next year. I'm going to try to see if I can get there next year. This was the first time since the pandemic they brought it back. I just learned this symposium that's been going on for 40 years. I just learned about a year or two ago, and I said, hey, you know what? I want to go to one. I want to make it happen. So it's not that far from where I live, so I'm definitely going to be at that one next year. So y'all better start responding back to my emails and get me up in there. I'm going to be at the Jackson Hole Summit, one way or the other, Debo style. But anyway, ladies and gentlemen, before I get up out of here, if you like this content and you want to help out children's financial literacy, go ahead and check out in the description box and contribute to our book drive, which is going on right now. Every dollar you donate will be matched all the way up to 10 grand. We're going to give out children's books to invest about investing, credit, and insurance to kids across America. So if you want to contribute, like what I do, you like what I've done, please go ahead and make a contribution in the link below. Contribution app, $1, $50, $2, $5, $5 million. It all will be accepted. All right. But anyway, ladies and gentlemen, boys and girls, that's my time. And to the next video, podcast, cartoon, or whatever else crazy you see me do around the globe, y'all already know my name. My name is Prince Dykes. I'm the Prince of Investment. And to the next video, podcast, peace, be safe. I'm out, and thank you.